Good morning to all. Today is the day 8 of Open Lecture Series program for undergraduate students, finance and its allied areas. Today our guest faculty is Amirul Sardar sir. He is an assistant professor at MIT University, Kolkata. He has 3 years of experience in higher education and actively engaged in teaching, research and student development. He has published several research papers and book chapters and has presented his work at numerous national and international conferences. Today's topic of discussion is ratio analysis. Over to you, sir.
Thank you so much for the kind introduction of mine. Good morning, everyone. I am Amirul Sardar, currently working as an assistant professor at Amity University, Kolkata. And it's truly a privilege to be here today. I would like to express my gratitude to the KBSAA for giving me this wonderful opportunity and a heartfelt thanks to Bimal Lama sir, our favorite sir in our university's days, for his constant support and encouragement. Uh, Dear students, today's session is on ratio analysis, a fundamental tool in financial analysis that help us interpret the numbers in financial statement. So ratio analysis is very important chapters in our undergraduate level. First of all, why ratio analysis is important in the viewpoint of business perspective. First of all, we are the students of business, and business means what? So those, if anyone present here, hello, yes. So what is business? And why we study today ratio analysis? Why it is important for business? First of all, business means is an economic activity or financial activity. What is the main motive of business? The main motive of business to earn profit. And what are the financial or economic activity involved in business? Exchange, distribution of goods and services. Now, for every business and in our undergraduate subject, whatever it is, accounting, finance, marketing, HR, every subject has some importance to do the business, to carry on the business. What is the importance of accounting? It's called, for example, finance is called the lifeblood of business. Without finance, without fund, business, we cannot run the business. Similarly, accounting is called the language of business. Why it is called the language of business? If you look for the definition of accounting, it is the process of recording. It is the process of recording, classifying, summarizing, analyzing, interpreting, and communicating. Now, analyzing and interpreting means basically where we ascertain the gross profit, net profit, the financial position of the business, and the cash flow statement, all the financial performances or financial uh, position we ascertain. And after that, interpret and communicate. The term, these two terms, interpretation and communication, what we interpret? We interpret, we interpret the financial performance, we interpret financial position. Through what? Through financial tools. So in accounting, there are many tools to analyzing the financial performance, to analyzing the balance sheet, that is financial position. And after that, we prepared the report to communicate one company's report towards the world. Now the question is why a company communicate their financial report towards the world? Because there is a stakeholder. And those stakeholders are interested parties of the business. And stakeholder, one is internal stakeholder, another one is the external stakeholders. So both the stakeholders, it's maybe management, financial managers, is the employee, bank, government, investors, shareholders, creditors, suppliers, lenders, customers, everyone is your company's, your business stakeholder. Now, these stakeholders are interested to know your business position, interested to know your business financial health. So why they interested to know? Because they are invested in your company. The investor who invested a lot of money to you. Now, the investor analyzing your company's health because to know that their investment is how much return from that investment. The creditors, the lenders who supply money to you, who supply goods to you, why they try to understand that this company is able to pay back to me or not. So they analyze your financial position or your financial company, your financial report. So every stakeholder, the management, shareholders, the management, after your final ratio analysis, they take the decision that this company's strength, weakness, what are the opportunities and threats over there. So that's why ratio analysis is very important in this discussion, because in a business perspective, everyone wants to understand that my business, what the main objective, the main motive to earn profit, that my business is profitable or is a loss-making business. And one of the two ratio and ratio, accounting ratio, financial ratio, help us to understand this. The first, the introduction of ratio. So firstly, ratio analysis is a qualitative method to assess a firm's financial health, what I discussed. So it's a quantitative as well as quantitative. Ratio means what? Ratio means a proportion. Ratio is a proportion between the two figures. So when accounting ratio means it is the proportion, the figures, one is income statement. We raise the figures from income statement. We raise the figures from the balance sheet statement. Balance sheet. So these two statements, we raise the figures, and in proportionately, we analyze the company's health or company's position or company's performance. So that's why it is a quantitative method. It is a quantitative method through which we analyze the company's or firm's financial health. Secondly, ratio analysis helps stakeholders like investors, creditors, management in their decision making. Investors who take the decisions, who take the decision that am I invest XYZ company or ABC company or PQR company, which company I invest. So on the basis of different kind of ratios, for example, the profitability ratios, return on assets, return on equity, return on capital employed, earning per shares. So different ratios they analyze. After analyzing all those ratios, they are going to invest the company. Okay. And for example, the management means if I see the pictures of our structure of the management of the company, the topmost management, middle management, and the lower management. Topmost management, who are the board of directors, chief executive officer, the executive director, and then different kind of middle manager like your finance manager, purchase manager, your operation manager, HR manager. So they analyzing, they are the core of the company's management, and by the help of the ratio analysis, they take the decision and they find out that what are the strength area, what are the weakness area of my company. Secondly, it compares the relationship between financial statement items. It compares the relationship between financial statement item. You have two items, and in our recent days, there's one program on TV, Shark Tank. They're asking, what is your gross profit margin? What is your net profit margin? What is the debt? What is the ratio of debt and equity? So this type of question they're asking. Now, how you understand and what would be your answer? So by the help of the ratio analysis or ratio, you can answer this question that this is my gross profit margin after dividing the gross profit by net sales or revenue into 100. And that interprets something, net profit margin, everything. So ratio analysis for the company's point of view, it compares the relationship between the financial statement items. It helps you to understand that one company's performance to another company's performance. So these are the ratio analysis. The first of all, then second is what is the objective of ratio analysis? Why we do the ratio analysis? It's the main purpose of ratio analysis. The first objective is to evaluate the profitability. So I mentioned that every business, the main objective of business to earn profit. The motive of the business to earn profit and the creation of the value for the shareholders. The first objective is to evaluate the profitability of the company, that my company is able to earn profit or not. So how you understand this? You understand by the help of ratio. Different kind of ratio like gross profit ratio, net profit ratio, operating ratio, return on assets, return on equity, return on capital employed. So DuPont analysis, different analysis through which you can understand that your company's ratio or company's profitability. Second thing you evaluate through the ratios is the liquidity of your company. Liquidity is the short-term ability of your companies that you able to pay to your short-term within the operating period. You are able to pay to your lenders or not. You're able to pay to your creditors or not. So ratio analysis helps you to understand the liquidity of your business. Then the solvency, it evaluates the solvency of your business. Solvency means what? Solvency means the long-term ability, the long-term payability. Liquidity, the difference between liquidity and solvency. Liquidity means you are able to pay the short-term liability of your companies or not. Solvency ratio helps you, or solvency, that you evaluate that your company is able to pay the long-term liability of your company or not. And you evaluate the operational efficiency of your company. Operational efficiency, your company's operations, how your company is performing, what is your operations. So how you evaluate your company's profitability, how you evaluate your company's liquidity, how you evaluate your company's solvency, how you evaluate your company's operational efficiency. You evaluate through the different kind of ratios, and ratios from the financial statement or financial statement like income statement, like balance sheet statement. From where you can evaluate your company's financial health, your company's financial position. After that, the second objective, most important objective, is the benchmark performance. Benchmark performance with industry standard. That your industry, what your industry standard? That performance you analysis and compared with another, your same industry with another companies. And third and most important objective, why a company do the ratio analysis? The objective is the assist in financial forecasting and planning. Financial forecasting and planning. So financial forecasting is very important. Planning is very important for the company's perspective. Why? And financial forecasting means you forecast what on the basis of your current year's profit, in current year gross profit margin, current year's net profit margin, current year's inventory turnover, current year's your working capital ratio. On the basis of that, you can analysis your company's forecasting. You can forecast your company's performance. You can plan accordingly. So who help in it? Ratio, accounting ratio or financial ratio help us to understand or to forecast or planning the financial ratios. So basically, financial ratio is a quantitative measures we can say, and that uses to assess a business, to measure a business. Basically, what we discussed today, that ratio means it is a measure. Measure of what? Measure of financial statement. Why we measure? To assess the business performance. To assess the business performance. And who use this ratio? Specifically, I told you the interested parties of your company is the internal stakeholder and external stakeholder. And specifically used by financial analyst, equity research analysts, investors, asset management. Financial analyst, equity research analyst, your investors, your asset management. Why the analyst? To evaluate the overall financial health of your business. Overall financial health of your business with the end goal of making better investment decision. So why they do? Because for better investment decision. That's why. So we can say it is a great way. It is a ratio analysis. Why it is important in the business perspective? Because it is a great way to compare two companies that are different in size, operations, management style. They are different. Their operation, their management, their size is different from each other. But they can compare with the ratio. And that's why ratio is called is a great way. And it is also a gateway to quantify how efficient a company's operation and how profitable the business. Your company's operation and profitable, we can analysis through the ratios. I hope it is clear the introduction part. I told you that what is ratio, why we study ratio, what is the importance in business perspective, what are the objective of ratio analysis. I hope it's clear to everyone. After that, the main part in undergraduate level, that what are the financial ratios over there? What are the accounting ratios is basically divided, some books divided in 4 parts, and some book it's divided in income statement ratio and the financial statement ratios. So first, there are 4 types of ratios. First is the liquidity ratio, after that solvency ratio, then profitability ratios, then activity or efficiency ratios. So 4 ratios over there. So through liquidity ratios, we study today through liquidity ratio, a company, what kind of operation, how liquidity ratio helps companies' operations, how solvency ratio helps company, how profitability ratio helps company. So every ratio, how efficiency ratio. So these 4 ratio help the company, help the business to understand different operation or company's financial health or financial position. So one by one, we study and understand the every ratios with the problem and concept. First, I make the concept, clarify the concept. After that, going towards the problem solving. Okay, and give you some homework. So first is the liquidity ratio. First of all, liquidity ratio are used by, I told you, it is a financial analyst. Why? Financial analysis means basically creditors. Creditors is treated as a current liability of our business, who are the suppliers of raw materials. And your business is liable to pay, you are obliged to pay to the creditors. Now, the creditors analyzing after you express your financial report in different website or in your company's website, then the analysis that I supplied, means creditors supplied the raw materials to certain companies, that the company is able to pay back to me. Creditors get to understand this thing. So through liquidity ratio, through current ratio, through quick ratio, we can understand that yes, this company is able to pay back to me. The company is able to pay back to me. So this ratio measures company's ability to repay both short-term debt obligations. So liquidity ratios are often used to determine the riskiness of a firm to decide whether to extend credit to the firm or not. Okay, so first ratio is the current ratio and otherwise known as the working capital ratio. The first is the current ratio. What is current ratio? And it is otherwise it said is a working capital ratio. What is working capital ratio? Working capital ratio is just the difference between current assets and current liability. What is the significance of it? It measures the ability of a business to meet its short-term obligations that are due within a year. Why short-term? Because that due within a year, within the one operation period. The ratio compares total current assets. You can see in our PPT is a compares between the total current assets to total current liabilities. And the current ratio looks at how a company can maximize the liquidity of its current assets. How a company can maximize the liquidity of its current assets to settle the debt obligation. To settle their debt obligation, their company's debt obligations, the company can maximize the liquidity of its current assets. So what is the ratio? The current assets divided by current liabilities, and one significance in a short form measures the short-term liquidity. So a current ratio greater than 1 suggests financial well-being for a company. So a current ratio, if it is greater than 1 means your current asset is more than your current liabilities. Now, to explain this for the undergraduate student, I want to recall that what is current assets and what is current liability. Just 2 minutes to explain this. Current assets means those assets which are liquidated or converted within the year, converted into cash within one accounting year or within the operation of the business. That is called current assets. So what are the current assets we mention in our balance sheet or in your business? Current assets like your debtors, means your customer, your bills receivable, both we call trade receivables, cash and bank balance, prepaid, marketable securities. All these are treated as a current assets of the company. What is current liability? Current liability means your obligations. You are obliged to pay to others. That is liability. So current liabilities is the example of current liabilities: creditors, bills payable, bank overdraft, outstanding expenses. All these are called the current liabilities. So in our balance sheet statement that express the financial position of our company, that when we divide all the current assets, total current assets divided by total current liabilities, we can get the ratio. If the ratio is 2:1, that means current ratio is double than the current liabilities. It's a good one. It's called the ideal ratio for the company. And if it is greater than 1, it suggests that the company is financially well-being for a company. It is the financial well-being. Second is the quick ratio. So first of all, what is quick ratio? Why it is mentioned? The term is quick. Why it is quick? Quick ratio, also known, is another name of the quick ratio is acid test ratio, ATR. Quick ratio, another name is the ATR, acid test ratio. Now, what is acid test ratio? It measure, and what is the significance of it? The significance of it, it measures the ability of a business. The ability of a business. What ability? To pay its short-term liabilities by having assets that are readily convertible into cash. Why quick? Why the term quick? Those assets, those current assets, which are readily convertible into cash. That's why it is mentioned quick. These assets, what are the assets? Cash, marketable securities, accounts receivable. These assets are considered quick asset because they can be quickly and easily converted into cash. So you know, current asset means stock or inventory, your debtors, cash, marketable securities, accounts pay, accounts receivable. But in our quick ratio, we deduct the inventory. We not include it in our current assets inventory. So why quick? Because those current assets, debtors, marketable securities, cash, which are readily convertible into cash, easily convertible into cash, that's why it is called quick. So when in your current assets inventory or stock included, we exclude it. We exclude the current inventory for the quick. That's why the term is quick, divided by your current liabilities. Therefore, the quick ratio exclude accounts such as inventories and prepaid expenses. Your inventory and prepaid expenses excluded from your current assets. It measures the immediate liquidity of your business. Immediate liquidity. So I hope, so in our liquidity ratio, there are mainly its liquidity or short-term solvency. It measures ability of the business to pay its short-term liabilities. If your company is inability to pay off short-term liabilities, it affects its creditability as well as its credit rating. So it's very important. Can you imagine? This ratio helps you that your company's performance, credit rating. If you are unable to pay off your short-term liabilities, it affects in your company's picture, creditability, and your credit rating from the credit agency will be lower, and that affects in your company's in your business. So why accounting is important in your for every business? That's why accounting is called the language of business. It expresses, communicate company's position, company's health, and through which all take the decisions. So we understood two things. One is current ratio, another is a quick ratio. There is another liquidity ratio, cash ratio, and defensive ratio, interval ratio, different kind of ratios over there. We have very minimum time, and it's a ratio analysis is a very big chapter. So a little bit discussion on it, the main part of the ratios. So we understood this, the formula, the concept, two ratios. Now we solve the problem. Try to understand through the company's true picture. So you can see this. The first question, they're asking compute the current ratio and quick ratio from the following figures. From the following figures extracted from X and Company Limited. So one company's some informations, balance sheet informations is given in front of you. So here given goodwill. So we have to find out according to our formula. The formula is, current ratio CR equal to current assets by current liabilities. This is the formula. Now, current assets, you have to find out what are the current assets in your balance sheet. Goodwill, it's not a current asset. It is a intangible fixed assets. Intangible fixed assets. Land and building, tangible fixed assets. Inventories. Inventories, your current assets. So you write inventories first. Inventories plus your sundry debtors. Debtors is also your current assets plus cash, your current assets. After that, payment in advance is also a current assets. Payment it is also a current assets. Plus, so we better to write advance. After that, bills receivable, BR, it's also a current assets. Plus advance income tax paid, it also a current asset. After that, sundry creditors, it's your current liability, bills payable, current liability, short-term loan, provision for taxes, proposed dividend. So inventory, sundry debtors, your cash, payment in advance, bills receivable, advance income tax. So these are the current assets divided by your current liabilities is creditors plus your bills payable, BP, bills payable. After that, short-term loan plus your provision for taxation, provision for taxation plus your proposed dividend. So these are the current assets, current liabilities. So after adding all this, inventories, data, cash, advance, it's around 51,450. If you add is 51,450. 450 divided by liabilities is your 34,300. 34,300. So if you calculate it, the ratio is, what is the ratio? 0.87 is to 1. So as per our discussion, why we do this? It's a simple one. Current assets by current liability. If you have the knowledge of current assets and current liabilities, you just put the information, calculate the ratio. But the main part is the interpretation. If you are the finance manager or financial analyst of your any company, so how you interpret this? You add all the current assets divided by current liabilities, you get the ratio 0.87 is to 1. It means I told you in my discussion that more than 1, so it indicates the financial well-being. And the ideal ratio is 2 is to 1. But here, the ratio is 0.87, which is less than 1. And current liabilities is more. So what it shows? It shows the inability of the pay of the short-term liability. Inability of the payoff of the short-term liability to the creditors or any others liability holders. So it's not good for your company. Okay. And if we calculate the quick ratio, you just current assets, quick ratio QR equal to, you just, what you do? Current from current assets, current liabilities, current assets minus stock minus payment in advance. So current assets minus you all the, which quick means which is quickly convertible. So from current assets, that is 51,450, you deduct inventory, which is take time to convert, payment in advance, advance minus advance income, advance income tax, IT, you deduct all this. Divided by your current liabilities, Okay. So after putting the value, the ratio is point, sorry, quick ratio is 0.87 is to 1, and our current ratio is 1.5 is to 1. So this is our current ratio, 0.15 is to 1. It's a good one. It's more than 1. It indicates the financial well-being of the company. But the quick ratio is 0.87 is to 1. And the ideal ratio for the quick ratio is the 1. So with the help of these informations, we calculate two ratio. We understand what is current ratio, what is quick ratio, what is liquidity ratio, and then we solve the problem. Number 2, please click the screen, take a screenshot. Number 2 is your homework. You solve it and send it to the comment box. I will check. So this is your homework. A business has a current ratio of 3:1. It's important. It's very important. A business has a current ratio of 3:1. Its net working capital 4 lakhs and inventory is 2,50,000. Calculate quick ratio. I just give you some hints. Quick ratio, you know, current assets, that is quick assets, divided by quick liabilities. Quick assets means current assets minus stock minus prepaid expenses. Current assets minus stock minus prepaid expenses. Or you can add debtors, receivable, cash, debtors, cash, marketable securities divided by current liabilities. So here current ratio is mentioned. Current ratio means current assets by current liability. You put the formula, then the ratio 3/1. Net working capital 4 lakhs. So one information given. Working capital means current assets minus current liabilities. So you get this one 4 lakhs. Then inventory stock information is given. Then you calculate the quick ratio, put the formula and take the informations and calculate. So it's your homework. You calculate and send it to the comment box for all the undergraduate students. So today's discussion basically the basic ratio analysis. Ratio analysis is not for the undergraduate, it's postgraduate students also. But today's discussion is a very basic one. Is it clear, everyone? After that, I'm coming to the leverage ratio or long-term solvency ratio. Solvency ratio, basically, it's a, what is the difference I told you between the liquidity ratio and solvency ratio? Liquidity is for short-term ability shows and solvency ratio that my company is able to pay the long-term liability. Company is liable to the outsiders. Now, analysis, my company is able to pay or not, able to pay the long-term liability or not. So there are many ratios. There is a from financial structure, that's equity ratios, the long term. In our balance sheet, the liability side is two kind of liability. One is the long-term liability or fixed liability. Another one is the current liabilities. So I discussed in liquidity ratio all the current short-term period. Now in leverage ratio or solvency ratio, here all the ratios are related to the long term. So you can say equity is a long term, debt long term. All these here, preference share capital, debentures, borrowings, all these are the long-term liability of the companies. So here, share first is the equity ratio. What is equity ratio? Equity means what? Equity is the ownership. It represents the ownership of the business. Equity represent the ownership of the business. So how you get this? The formula simple. Simply you have to understand in ratio analysis, beside your conceptual clarity, you have to remember the ratio. Equity ratio means what? Equity ratio is the shareholders' equity by net assets of your business, of your company. Shareholders' equity mentioned in your question paper or mentioned in your balance sheet divided by divided by net assets. The interpretation is the main part I told you. What is indicates? It indicates the proportion owner's fund. You know, there are two kinds of liability. There are two kinds of liability. One is internal liability. Another one is the external liability of the business. Internal liability means the owner who invested, that treated as a capital of the business. It's the owner's fund. Equity, which indicates the owner's fund, which is internal liability of the company. So my question is, as to the undergraduate student, why it is internal liability and which accounting concept applies here that owner's investment is treated as a liability? Which accounting concept applies here? The answer is the accounting concept is business entity concept. According to business entity assumption or concept, accounting concept, it says that the owner and the business, they are separate from each other. They are distinct from each other. They are not same. They are distinct. They are separate. So whenever the shareholders, the owner invest in the company, if you purchase 1 shares of the company, you are the owner of the company. If you purchase 10 shares of the company, you are the owner of the company. So whenever you invest in the company, you are treated as an owner of the company, and it is the liability of the company according to the business entity concept. Okay. Then, so I told you two kinds of liabilities. One is the internal, that is equity. Another one is the outsider or external liability of the company or external fund of the company. The fund or liability is the debt, debentures, or long-term borrowing from the business. So these are the external liability of the company. So the management analysis all the ratios as well as external liability provider and external fund provider, they also analysis of your company's performance through the tool of the ratio. Debenture holder, they analysis. Debt provider, they also analysis. So everyone, creditors analysis. So second one is the debt ratio. So how you calculate this debt ratio? Total debt divided by net assets. Total debt divided by net assets. So total debt means it is short term. Total, whenever it is mentioned total debt, it means short term plus long term. Short term debt plus long term debt. So it analyzes the company's long term solvency. Company's long term solvency. So greater than 1, when it is debt ratio is greater than 1. If your calculations, your answer is greater than 1, treated as a risky for the business. So when it is greater than 1, it is risky for your business. Then it's come to, as per the capital structure in our financial management, we studied the capital structure. Capital structure means the fund procurement decision of the finance manager. So there is ratio, very important ratio is debt equity ratio. We studied first, we studied debt, Now, so now your debt equity ratio means total debt by shareholders equity. Shareholders equity. So first, shareholder equity means equity, shareholders equity by net assets into total debt by net assets. So we get the debt equity ratio, total debt by shareholders equity. It indicates long-term financial stability. If you want to know your company's or business long-term financial stability, then you use the debt equity ratio. What is the formula? Total debt by shareholders equity. And next important is the debt to total assets. This one. Debt to total assets, total debt by total assets. You have to remember all this formula because of the whenever you go for the ratio analysis, you have to remember, and as well as the knowledge of different kind of financial statement and balance sheet. So what is the debt equity? Debt to total assets, total debt by total assets. Simple. Total debt by total assets. Just a minute. My battery is low. Total debt by total assets. Then your interest coverage ratio. Interest coverage ratio means how a company, how many times a company can cover its current interest payment with its available earnings. With its available earnings. So interest coverage ratio means EBIT divided by interest expense. So EBIT means what? EBIT, earning before interest and tax. EBIT means earning before interest and tax. Hello, Raj. আমার একটু চার্জে তো দিয়ে যাও তো আমার ডেস্কে আছে রাখেন হ্যাঁ এই 310 আছে 310 sorry for the inconvenience due to my battery low of my laptop. So interest coverage ratio means, so it is EBIT. EBIT we understood, earning before interest and taxation. How we get it? Sales of your company, total sales minus variable cost, total sales minus variable cost, to get the contribution of your business, total contribution minus fixed cost, you get the EBIT of your business. So EBIT means earning before interest and taxation divided by interest expense. Divided by interest expense. So what is the indications? What is the indications? The interpretation is that how many times a company can cover its current interest payment with its available earnings. With its available earnings. Sorry, just a minute. I have to put on the charger. Sorry for the inconvenience. Yes, we discussed through What we discussed, that's the leverage ratio or different kind of solvency ratio. So interest coverage ratio I explained. That was the interpretations, how many times a company can cover its current interest payment. How many times a company can cover its current interest payment with its available earnings. So company has some available earnings that represent EBIT, and interest expense means what? Interest expense means your debentures, you uh, raise the fund through debentures, you raise the fund through the loan. So you have to pay the interest. That in your year, how many times a company can cover its current interest payment with its available earnings. Whatever the earnings available, from that, your company is able to pay the interest to the interest from where you raise the fund. So that represent your interest coverage ratio. After that, the important one, capital gearing ratio. Capital gearing means what? How we get it? Capital gearing, preference share capital plus debenture plus debentures plus other borrowings. So first, see, it's clear. In capital structure means from where you raise the fund, equity shares, debentures, debt. These are the sources. Now, capital gearing, preference share capital plus debentures plus other borrowings divided by equity. You get the capital gearing. So what is represent? That's the main important part. It reflects the proportion of fixed charges. Fixed charges, which is fixed interest payment. Fixed interest, for example, your debenture, fixed interest. Loan, you raise the fund through the loan from a financing institutions. There are fixed charges. Dividend, fixed dividend, preference dividend. So our preferential capital, fixed dividend, a debenture, fixed interest, other borrowings, fixed interest. So it's reflect the proportion of fixed charges. Reflects the proportion of fixed charges bearing capital, fixed charges bearing capital, and that to funds belonging to equity shareholders, and that bearing capital belonging to the equity shareholders. So in solvency ratio, the long-term ratio, we studied once again equity, debt, debt equity, debt to total assets, interest coverage, capital gearing. Now we're going to solve one problem to understand this ratio, but it's not possible to solve every ratios because of time limitations. So I take on problem from the following informations, calculate from the following informations, calculate debt equity ratio and current ratio. So here's share capital 1,50,000, bills payable, creditors, debentures, debtors, bank balance, long-term loan, general reserve. So information given to you in your question paper. So you have to calculate before. So why to know the formula? Why you need to know the formula? Because to calculate the ratio, you have to remember it. In this informations available, but you have to find out which is going to, which is applicable for the debt equity ratio, which is applicable for the current ratio. For the debt equity ratio, which one is applicable? I know long-term debt divided by shareholders fund. So I'm writing debt equity ratio equal to long-term debt divided by shareholders fund. Long-term debt divided by shareholders fund. So now, long-term debt in our problem, what is available? One is your Debentures, another one is the long-term loan. Debentures plus long-term loan. Remember, it's just a basic class. There's very tough problem. Just choose a simple problem to understand the concept. Debentures plus long-term loan divided by shareholders fund. So divide then equal to the debentures plus long-term loan. How much? Debentures is 2,75,000. 2,75,000 plus what is the long-term loan amount? Bills payable, creditors, debenture, debtors, bank loans. Long-term loan is 1 lakh. So 1 lakh, 1 lakh divided by shareholders fund. Remember, shareholders funds mean equity share capital. Equity shares capital. Here shareholders funds means better to write equity share capital plus general reserve. So in our problem, equity share capital is 1,50,000. 1,50,000 plus your general reserve is given in our question paper 20,000. So it is 3,75,000 divided by 1,70,000. 1,70,000. So equal to what is the answer? The answer is 2.2. 2.2 is to 1. 2.2 is to 1. So this is our answer. So it means what? It represents that your debt is more than your equity. Your borrowing fund, your outsider fund is more than your owner's capital. Is that represent for your company? Is it clear, everyone? Okay. So number 3 is the profitability ratio. Why it is important? It is represent your company's profitability. Your company's profitability. It's a financial matrix. It's called the financial matrix that used by the analyst and investors to measure and evaluate the ability of a company to generate income or profit relative to revenue. Okay, that your company is generate income or profit that related to the revenue. Revenue means sales, balance sheet asset, operating cost, shareholders equity during a specific period of time, during an accounting period, that your company is able to generate returns or profit relative to revenue in sales, balance sheet, your balance sheet assets, operating cost, shareholders equity during a specific period of time. And it shows how well a company utilizes its asset to produce profit and value to the shareholders. Our objective of business, two things. One is to earn profit and to create the value to the shareholders. Profit maximization and create the value for the shareholders. And profitability ratios are those ratios which helps you to understand this. So it's divided in two parts. One is return ratio, another one is the margin ratios. In our beginning of these lectures, I told you that in your sub 10 program, they're asking what is your gross profit margin, operating profit margin, net profit margin. So how you understand this? Through the profitability ratio. So first is the return ratios is very important because those who are invested in your company, they are interested to know the return of your business. So most importantly, return on equity, return on assets, return on capital employed, these all are the very important for your business. Is it clear, everyone? So return on equity means net income by shareholders' equity. So what is return on equity? What is the, I provide you an overview of it. Return on equity is a measure of a company's annual return. It is a measure of what? A company's annual return. Annual return means what? Annual return means net income. Net income. Annual return means your net income and that divided by the value of its total shareholders' equity. Annual return means net income divided by the total shareholders' equity. And you remember this, it's always expressed in percentage form. In our, we put these two ratio, liquidity, solvency. These are expressed in ratio form. That 1:1, 2:1, 0.87:1 is expressed in it. But profitability ratio expressed in percentage. Expressed in percentage. Clear? And next one is the return on assets. So what is return on assets? Return on assets means net income by total assets. Return on asset means net income by total assets. So return on asset is a type of profitability ratio that measures the profitability of a business in relation to its total asset. What is measured? It measures the profitability of your business in relation to the total assets. This ratio indicates how well a company is performing, by comparing the profit or net income it's generating to the total capital it has invested in asset. So from the company's perspective, return on assets means company invested in asset. Company invested in resource. Company invested in that resource from where economic value generated. Now, how much value generate? What incomes generate? How you understand this? You understand through this ratio, ROA, return on assets, is the profitability measures ratio. These two, return on equity, return on asset, and also return on capital employed. Return on capital employed. So what is return on capital employed? And the most importantly, return on assets. What is interpret? It's formally an important ratio in analyzing companies' profitability. This ratio is typically used when companies' performance between periods. So if you want to compare between 2024-23's company's performance, or for example, any business, any firm performance through the return on assets. Okay? So it is very important to consider the scale of a business and the operation performed when comparing to different ROA. Clear, everyone? So formula interpretations. Now, the next one is the return on capital employed. Capital employed, simple. Return you consider EBIT, earning before interest and tax divided by capital employed. Earning before interest. What is the significance of this ratio? Return on capital employed is also a profitability ratio. It measures how efficiently a company is using its capital to generate profit. Same thing, same concept. ROA, how efficiently company use its asset to generate income. ROE, how efficiently company use its capital to generate income. ROC, capital employed, how company generate revenue, how company generate income, how company generate profit out of its capital employed. Okay, so return on capital employed is considered one of the best profitability ratio and is commonly used by investors to determine whether a company is suitable to invest in it. Company and investor analysis, that is this company is suitable to invest in it. How they understood. One of the measure is ROCE, return on capital employed. Clear? So what is the interpretations? The return ROCE shows how much operating income is generated for each rupees invested. For each rupee, how much operating profit generate, operating income generate. Remember, higher ROCE always more favorable. If your ROCE is higher, you compare 2 years. One is 23, 24. You compare these 2 years ROCE. If 24 is higher than 23 ROCE, then 24 higher. That's why it is favorable for your business. It means your company generate income, able to generate income out of your capital. After that, margin ratio. Margin ratio is represent the company's ability to convert sales into profit. Return ratio, you analyze all the return, all the profit. To easily remember this. Margin means where you sales, you consider turnover at various degree of measurement. Margin ratio typically look at the certain returns when compared to the top line revenue. Typically, it compares income statement item. So we can see margin typically consider the income statement item, trading, PL items. But return ratio, they consider the balance sheet items. So in our margin ratio, what are the important margin? Gross margin ratio, operating profit margin ratio, net profit margin ratio. So before this margin, I want to calculate one ratio of regarding our capital employed. So we understood what is capital employed, what is the importance. Remember the formula EBIT by capital employed. So we have to find out from the information given. Number 4, from the following information, calculate return on capital employed. So they are asking for to calculate the return on capital employed. So how you calculate this? What are the information given? Share capital. 2 lakh equity shares, face value is 10. General reserve, profit and loss account balance, 15% debentures, profit before tax, provision for tax. This information given. Now the solution. Solution, first you have to calculate the EBIT. EBIT. Now here in this problem, EBIT information is given. EBIT information? No. So first you calculate the EBIT, calculation of earning before interest and tax. First you calculate EBIT, because for to calculate ROCE you need the EBIT. Okay guys? So how you get the EBIT? I told you EBIT means sales minus variable cost minus equal to contribution. Sales minus variable cost equal to contribution. Contribution minus fixed cost, it's EBIT. EBIT means earning before interest and tax. So if I deduct your profit in our information, profit before tax is given. So you have to reverse calculations. Profit and loss account is 5 lakh, profit before tax is 14 lakhs. Yes. So the reverse calculation, earning before tax or profit before tax or earning before tax equal to how much? Equal to 14 lakhs. 14 lakhs and your interest, interest how much? Debenture interest. If you add this, add debenture interest 15% of 3 lakhs. It means 4 lakh 50. 4 lakhs 50. I just provide you the concept. And you, with the base of this concept, further you calculate from the previous year question paper. So it's a back calculations. To get EBIT is a back calculations because earning before interest and tax information given to pay, coming to the EBIT. So if I add these two, what we get? The EBIT amount is total amount. It's 18 lakh 50,000. 18 lakhs 18 lakhs okay, 18 lakhs 50,000. It's your EBIT. Now, second information is capital employed. How you calculate this? Second calculation of capital employed. Calculation of capital employed. You add all this: share capital, general reserve, profit and loss, share capital plus general reserve plus PL. Okay. Net worth, you get the net worth plus debenture. Total capital employed. Total how much you employ? Debenture. So if you add all the amount, you can see from the problem, share capital 20, general reserve 15, 35, then 5 lakhs profit, so 40, and debenture is 30, 70. Your 70,000, 70 lakhs, not 70,000, 70 lakhs, your capital employed. Now the formula, return on capital employed. The formula is EBIT divided by your total capital employed. So simply, EBIT you got how much? 1850. 1850 divided by your capital employed. So you got the answer is 26, and you know it's always expressed in percentage. So the percentage is 26.43%. That's the answer. 26.43%. Clear, everyone? How to calculate ROCE? How to calculate ROCE? EBIT by capital employed. In our problem, EBIT information was not given. We calculate it And after that, we calculate the capital employed. Return on equity, net income by shareholders' equity, net income by total assets. You can see this one. Companies had net profit 5 lakhs, total assets given 25. So you get the ROA, and also shareholders' equity, you get the ROE. So this is your homework. Is it easiest one? Just the information. This one is homework. You send the solution. I expect from you. After discussion this chapter, you will able to calculate the ratios. Okay. And from the margin is very easy. Gross margin, gross profit by sales into 100. I'm taking a cumulative example. For example, gross profit margin. Easy one. For example, GP margin. So if in your information given, for example, gross profit divided by turnover or sales or revenue into 100. One hypothetical example, for example, gross profit is 50,000. Your revenue is, what I say, revenue is 5 lakhs. Hypothetical example, 5 lakhs into 100, the gross profit margin. So it is 4. So 1 by 10, so 10%. Okay. 5 by 50, and so 10, so 10%. 10% is the profit. So similarly, net profit margin, same formula. Net profit margin, same formula. Just you change your net profit by revenue into 100. Formula same, information will be given to your question paper. You just calculate. Okay, everyone. After that, activity or efficiency ratio. In our discussion, the last ratio is activity and efficiency ratio. This one, so the activity and efficiency ratio why it is used to measure the how well a company is utilizing its assets and resources, and it expresses in turnover times accounts receivable turnover ratio, activity ratio, efficient ratio, how your company is, how well a company is efficient or not, is utilizing its assets and resources. So there are few important activity or efficiency ratio used by the company. Accounts receivable turnover ratio, creditors turnover ratio, asset turnover ratio, inventory turnover ratio. So these all are the ratio. Accounts receivable or debtors turnover, the formula is credit sales by trade receivables. Credit sales, sales is 2 types. One is cash sales, another one is the credit sales. So if your company make the credit sales divided by trade receivables. Trade receivable means debtors bills receivable. What is creditors turnover ratio? Credit sales divided by trade payables. What's credit sales? Creditors is credit purchased. Right? Trade payables. So why? Debtors means your customer. You are selling. Credit sales. That's why debtors created. So credit sales by trade receivable. Creditors means who supply to you, who supply goods or services to you on credit. So credit purchase by trade payables. Asset turnover ratio, it's turnover divided by total assets. Simple. Asset turnover ratio, turnover divided by total assets. And the inventory turnover ratio, stock turnover ratio, cost of goods sold divided by average inventory. Now you tell me, what is cost of goods sold? Generally, cost of goods sold or cost of sales we record in the trading account to ascertain the gross profit of the business. So in our trading account, in the debit side, our expenses, opening stock, purchase, additional purchase or other expenses minus closing stock, we get the cost of goods sold. Average inventory means opening inventory plus closing inventory divided by 2. To get the average inventory. Is it clear, everyone? So these are the ratios, activity ratios, accounts receivable or debtors turnover ratio, creditors turnover ratio, asset turnover ratio, and the inventory turnover ratio. Now, account receivable, what is the significance of it? The account receivable turnover ratio, sometimes known as the debtors turnover ratio. And what is measures? It measures the number of times. I told you activity ratio expressed in times. It means how many times over a specific period that a company collects its average accounts receivable. So you make the sales on credit, that period, operating period, how many times the company collect it. The accounts receivable turnover ratio can also be manipulated to obtain the average number of days it takes to collect credit sales from customers. Okay, so the interpretation to calculate this ratio, sales on credit means sales return. Sales on credit minus sales return minus sales allowances divided by average receivable. Average receivable means account receivable plus accounts receivable beginning, ending plus beginning, opening plus closing divided by 2, you get the average one of trade receivables. Okay, so now calculate one of the activity ratio. I can show you within this time one ratio, and rest you have to practice in your home. The number 6 problem. Following figures have been extracted from Sivalika Mills Limited. One company is there. And the information, inventories at the beginning of the year, inventories at the end of the year. Very simple question. Inventories turnover ratio is 8 times. Selling price 25% above cost. Compute the amount of gross profit and sales. Compute the amount of gross profit and sales. So it's a reverse question and very important and technical question. What are the information given? Inventories. So from these inventories, what we calculate? Average inventory? Yes or no? Average inventory. What is the formula? Average inventory? Opening plus closing. Opening stock plus closing stock. Divided by what? Divided by 2. Now, opening stock, how much given in your question paper? Inventories at the beginning of the year, 60,000. 60K plus inventories at the end of the year, 1 lakh. So 1 lakh 60 divided by 2. How much it is? Simple. It is 80,000. So rupees 80,000. This is your average inventory. Now, so average inventory calculated, opening stock plus closing stock divided by 2. Now the stock turnover. Inventories turnover given. Inventories turnover ratio. Inventories turnover ratio is given 8 times. Inventory turnover ratio equal to 8 times. So we just put the formula. Inventory turnover means what? I told you COGS, cost of goods sold, divided by average stock. Yes, equal to 8. Next, cost of goods sold, how much? Inventory 8 times, selling price 25% above cost. So cost of goods sold is not given. Cost of goods sold is not given. Average stock we calculated 80,000, 2, 3, 4 equal to 8. Or COGS by 8 means COGS is 1 lakh 16. No, 18 to 8, 6 lakh 40. 80,000, I show you. 80,000 into 8. 8 8s are 6 lakh 40,000. Sure. Okay. 6 lakh 40,000 is COGS. Cost of goods sold. Clear, everyone? Now, gross profit is 25%. They said gross profit, how much? Selling price 25% above cost. 25% above cost. So what is your gross profit? Simple. Gross profit is equal to 25% above cost. 25% is the profit. So 20, our selling price is 125. Simple. Cost price 100, profit 25, selling price 125. So 25% of how much? Of rupees 6 lakhs 40,000. How much it is? It is 1 lakh 60,000. Rupees 1 lakh 60,000. This is your gross profit. So now you tell me sales how much? Sales amount? Sales amount, cost of goods sold plus COGS plus GP. COGS you calculated 6 lakh 40. 6 lakhs 40,000 plus gross profit is 1 lakh 60,000. So it is equal to 8 lakhs. Yeah? Sales how much? Sales is 8 lakhs. 8 lakhs your sales. So they are asking for calculate the gross profit and sales. So you calculated gross profit 1 lakh 60,000 and your sales is 8 lakhs. Done. So these are the few problems given in your question paper. First we solve. So today's discussion, first I clarify what is accounting, what is business, what is the importance of ratio in business, what is financial statement, financial position, objective of ratio, why we calculate. So today's discussion is not only the just for your undergraduate student, but it is the concept that builds you for your future. It helps you to understand the ratios of the companies, the technical tools of the companies. And when you face the interview, this type of question asking. So go through all the questions, all the concept, watch the video, and you can understand. If you have any queries, you can ask the question in your comment box. So today's discussion, I first clarify the concept. After that, I give you problem. So every ratio I discussed, then provide one problem, one ratio discussed, then again provide one problem. So out of this problem, your homework, the second one, this is your homework. Make the screenshot. Second homework is yours. Number this one. Second is the this one. Number 5. Make the screenshot, take a screenshot. Okay. So all this. So today's discussion, this is my discussion. I know ratio is a very big chapter. It's not possible to cover in one class. So I'm very thankful to the KPSS and Lama sir and all the team members of this organization that the opportunities. I provide some of things of ratio analysis towards the students. I hope it will be helpful to the student. If you have any questions, you can ask to the comment box. I will reply. Thank you. Thank you very much, everyone. See you and wish you a best future for you. Thank you. Thank you so much.
With this, we are concluding today's session.